Welcome to my trading course. I'm Chuck and I've been trading for many years now. It actually took me quite a while to achieve profitability. During my journey, I wasted a lot of time and money investing in trading robots, EAs, and other bad products that claim they will make you rich quickly. Obviously, these promises were all too good to be true, and I realized that trading is a serious business which requires a serious approach. The objective of this course is to cut down this time for you so you can reach your goals a lot quicker than I did. I found a net trading US indexes. My favorite asset to trade is the S&P 500. This course will be packed with gold nuggets, so don't hesitate to hit the pause button and take notes as you progress into the video. Note that for the sake of brevity, I will not get into the rudiments of Forex. You should understand basic Forex vocabulary such as pip, buy, short, stop loss, take profit, and be familiar with simple operations like placing a pending order on the market. If you want to learn the basics of Forex trading, please let me know in the comments below, and I will consider covering that in future videos. Okay, let's get into the good stuff right away. So the first step in trading is not trading. Before you can think of buying a prop firm challenge or even simply placing your first trade, you gotta have a plan. You must have a set of rules. As you progress into your trading journey, you should make your own rules and respect them no matter what. If you are just starting out, I will present 7 rules which I personally follow. You may take them as your foundation and start building your empire right away. The first one is the level degree of risk per trade. You should never risk more than 1 to 3% per trade. If you're a new trader, stick to 1% max. This means that your stop loss should be equal to 1% of the balance in your account. So if you have a $1,000 account, you should never risk more than $10 on a single trade. This way, you leave yourself the margin to lose up to 100 trades in a row before blowing your account. If you follow this simple rule, you will outlast the average new trader on the Forex market. It's that simple. If you break this first rule in your beginner stage, you will almost certainly blow your account. Prove to yourself that you can be consistent before increasing to 2%. Take it from someone who has gone through all the early learning stage of trading. You will want to break this first rule, and for many reasons, but don't. For example, you could feel that your account is too small and that it's not worth trading with only 1% of it. You could feel comfortable on a certain pair, or you could feel invincible after a winning streak and decide to risk more, but that will just result in bigger losses in the event that you were wrong. So my advice is follow this first rule or don't trade at all. If you can't follow your own rules, you are setting yourself up for failure. Second rule. Never have more than 2 trades running at the same time. So personally, I don't take more than 2 trades in a single day. Focus on quality trades and not quantity. If it's not a AAA trade opportunity, don't take it. It's that simple. Do not overtrade. We'll get into how to spot a AAA trade in another video, but for now, let's focus on the rule. This rule is basic, but it will prevent you from overtrading, often resulting in losses, and it will also prevent you from what is called revenge trading, where you want to make your money back right after a loss. Rule number 3, do not revenge trade. It's in our human nature to look for ways to recover after a loss of any kind. But if you lose a trade, I recommend you stop trading for the day. You will almost certainly want to get back into the market to recover your money quickly, but chances are that desire will bias your perception and you will start to see patterns that don't even exist and risk losing even more. Revenge trades are generally the most damaging ones. Remember that every trade is an idea. If it doesn't go your way, just wait for the next opportunity. You could look at other charts to find another trade opportunity, but my advice would be just leave the market for the session. You will likely lose more if you're not in the right mindset. You don't have to make your money back in the next hour. Rule number 4, do not re-enter a losing trade. So let's say you opened a buy position on a pair and got stopped out by a huge wick, and now you see that the price is going back up. It would be tempting to reopen another buy, but don't. The market didn't react as you planned initially, and that's it. Do not re-enter. Which brings us to rule number 5. Accept a loss. If a trade is not going as you had hoped, don't add more position to that failing trade. Stubbornly maintaining that your idea was actually good. Accept the loss. Sure, you might better your position and end up recovering some money, but statistically, as a beginner, you won't. Just move on to the next trade. Rule number 6, always trade with a plan, meaning place your stop loss and your take profit before opening a trade. The stop placement will dictate the size of your trade. Remember the first rule? Your stop loss represents 1% of your account balance. So I recommend using the position size calculator on my FX book to calculate how big a trade you should open depending on your stop loss placement. I'll put the link down in the description. So you input your values in the empty field, the traded pairs, the account currency, the account balance. In the risk ratio, you will write your risk percentage. So 1%. In the stop loss, you write the interval between your entry and your stop loss in pips. And in the trade size, you will write 1. Now hit calculate and it will tell you how big your lot size should be. And that's it. It's pretty straightforward. Now this is probably the most important rule. Always journal your trade. Journal every trade you take. Literally all of them. Even and especially the ones you took without respecting your trading plan. The ones you shouldn't have taken but took anyway. You might just end up finding a key element to your rise to prosperity. So record all of your trades. It's the only way to build your stats and improve yourself. So the last rule brings us to the most important part of your trading journey. Journaling is another invaluable aspect of trading, which is seldom taken seriously. Every successful trader out there will tell you to journal your trades. It's the most important part of your trading journey. So by keeping a tight journal, you will build your stats and be able to identify patterns in your trading and improve based on them. When journaling, you should write down all the specs of the trade, why you took it, what you saw in the market, what outcome you expected, but also what actually happened in the end. So write down your emotions, how you felt during the trade, how you managed the trade. Maybe you exited too soon, maybe the market printed a rejection candle and you should have closed the trade at that point because deep down you knew it was the end of that movement. Or maybe you should have sat on your hands and let the trade play out as it was first intended. All that info will accumulate and you will eventually learn about yourself. You will learn how to manage your trades and your emotions. You might learn that most of the time you were right about the initial trade idea, but fiddled with it while it was running and spoiled the outcome. That was my case. It's the main thing I learned from my journal. I must sit on my hands and trust my initial analysis. I will share my trading journal template with you. You can start with it and adjust accordingly. I personally keep 2 journals, one for Forex trading and another one for index trading. You could have one for swing trades and another one for scalping trades, for example. But whatever you do, don't stop journaling your trades. Never stop. It will require discipline and commitment, but without it, your chances of becoming successful are slim. In the free template I'm sharing, which is in the form of a spreadsheet, there is a tab with explanation on how to use it. Feel free to alter it to your liking or create your own version. You'll find the link in the description. In the next phase of the course, we'll look at how to build a fundamental bias and how to bridge the fundamental and technical analysis. Once we'll have identified the direction in which we want to trade based on fundamental news and bias, we'll need to find the best possible trade on the chart. That's when the technical analysis comes into play. For this, we will use various tools and indicators. The technical analysis will help us place our stop loss to protect our trade and manage our risk, and would also help us place our take profit level to maximize our profits. So I'll put a link in the description for the next phase of the course, but be advised, it is not for beginners. If you're only getting started and not willing to put in the hard work to become a full-time trader, the next part is not for you. However, if you are ready to put in the effort, in the next phase, I will explain my entire trading strategy.